Hello everyone, welcome to this conversations in call. Today we have Mr. Rakesh Sethia, who's part of the HDFC Asset Management Fund Management team. He's been a fund manager and a senior equity analyst with a cumulative experience of more than 19 years, out of which around 17 years he was acting as an equity research analyst. He was previously working with Morgan Stanley and now part of the HDFC Asset Management Company since 2022. Welcome to this call, Rakesh. It's a pleasure having you here on this call.
Thank you so much, Kiran, for the kind introduction.
Yeah.
Look, it's very hard to say that there's only one thing because, that would like differentiating one over many, right? But I can tell you that if you ask me one, it's essentially the entire focus of the government machinery to promote manufacturing as a whole and looking at different sectors, trying to figure out what is being needed in each and individual sector, right? Historically, one could argue that since 1990, we as a country, as our policymakers, never had the focus on the manufacturing within a sector, and therefore it got sort of left behind in the entire growth curve. In today's context, there is a holistic feature about the manufacturing sectors, right? So that focus is let's say, is a reform, and then various policies, incentives, and changes that has happened as follow through of the same. It's really the focus which the government is bringing to ensure that the manufacturing becomes a large part of the growth. Look, we are convinced that this is a multi-decade thing, right? So it's not like a year, 1 year or 2 year or a 3 year theme. So basically, when it's a multi-decade theme, where the timing is sort of, let's call it, it does not matter whether we started yesterday or we should start tomorrow. The point is that if there's a theme that's going to grow, which means that the companies or the sectors exposed to the same are more likely to grow than not, and therefore, as an investor as a whole, can ride on that theme and trying to take advantage of growth that could come through. So, I can say two. So, for example, when I look at some of the peer portfolios, we do see some of the diversified FMCG names as part of the manufacturing theme. I think, what we want to call out is that this fund is going to be a little bit more narrower in approach when it tries to reach that manufacturing theme. Yes, there is a 20% flexibility one can use, but at least the core part of the portfolio, what we call that minimum 80% would be deployed in the manufacturing theme. That would have a slightly narrower approach. So, for example, we are calling out will not have diversified FMCG as part of the manufacturing theme. And secondly, I think, that's more, I think that differentiates probably our house in general and not specifically this fund is that the portfolio constructions are typically more bottom up because we have a very large research team, average experience of about 15-16 years. We cover close to 600 odd companies within ourselves, right? So that allows you to do that bottom up stock selection and therefore a portfolio construction. That doesn't mean that we don't look at top down. We do look at top down, but it's more from a risk management perspective, right? So, for example, if let's say we figure out, okay, these are the 40, 50, 60 odd businesses we want to own, then we can look at their sectoral aggregation, and then we can think of whether are we overexposed or underexposed to a particular sectors, and then do the course correction. So it's the approach to the portfolio construction that always been more of a bottom up than the top down. So about 14 odd sectors get qualified as the part of the manufacturing theme. But I think a right way to look at it would be the number of industries, right? So when I look at the number of industries, as we call it's defined as basic industries, there are about 85 basic industries. And even if I use just a arbitrary, let's say, constraint of looking at companies 1,000 crore market cap and above, so there could be roughly about 690 odd companies, or let's call it 700, that qualifies for the manufacturing thing, right? So when you can do the portfolio selection from this universe of 700 odd companies, and those are diversified or those are spread over those 85 industries. And it does not mean that we will not look at the companies below 1,000 crore market cap as an example, as an illustration, right? So the universe is quite broad based, spread over a large number of companies and industries to sort of select. So this fund has a benchmark called Nifty India Manufacturing Total Return Index. The benchmark has roughly about 77 stocks. It is broadly 75% large cap, and let's call it the remaining as a combination of mid and small cap. I think the differentiator for this fund would be that over a period of time, large part of the active risk would come from the stocks which would be outside the portfolio and not necessarily looking at the benchmark and trying to vary their bets. Right, the source of the active risk would be probably from the stock which is outside the benchmark. In terms of the question you asked, what could be the quantum of the active risk? So look, when I look at my peer portfolio, anywhere between the non-overlapping part of the benchmark is anywhere between 30% to 40%, right? So I think that's a fair amount of risk to take, in that sense. And depending on what is the source of that risk, if the source of risk is outside the benchmark, that's a good enough risk to take from a portfolio construction point of view. So short answer, broadly in the similar range.
Got you. And any minimum weights you want to consider to be at least trying to beat that benchmark on a medium to long term basis?
The sector, the benchmark do have sectoral caps and the minimum weights, right? But I'm not going to look at that way. The idea is to, have a reasonable amount of active risk in the portfolio. But sector not necessarily is the right way to look at it. I'll give an example, right? You could see, for example, a sector which is there in the benchmark, I could still be equivalent in that, let's say, portfolio construction, but it would be misleading. Especially if the number of stocks that could come from would be the outside of the benchmark, right? So the right way to look would be that I'm not bound by sectoral caps, and therefore I'm not going to look at that. Yes, the stock level weight does apply, which means that as is in the case of any diversified fund, you would have noticed that the maximum cap or a maximum weight of a stock would be 10%. So such capping would apply to this fund, but the sectoral capping doesn't apply in this context.
So predominantly, this will be a bottom-up approach, which you utilize
in a
very active way.
I do like auto comms to begin with. I do like healthcare to begin with. I think these two sectors definitely scores in terms of the what I like. But having said that, even if you look at some of these sectors, from the aggregate weight of what I explained, that when you look at this basket of 700 companies, this is about 16-17%. So again, that allows you to do that stock picking. You may like something, you may not like a particular sector, but within that sector, you must still figure out companies which you like, and it may appear that you don't like the sector because the sector might have lower weight relative to the benchmark, but those stocks could be completely out of the benchmark, and it could still become a large source of the active risk. So what I'm trying to say is, all those all the questions, when you look at just the available opportunity, a right way to think about is the number of levers or the number of companies is quite large, spread across many industries. That gives the flexibility to choose theme which is exposed to the manufacturing, and pick and choose cycles based, depending on some of those industries probably would be over a period of time. No, that's a great question. While I can, I can say, look, we would be market cap agnostic, and I think that's a right way to think about this product over a long period of time. That you should be market cap agnostic. Having said that, our market do have these, liquidity constraints, right? So, I may want to build let's say, a very small cap dominated portfolio over a long period of time, but frankly, enough liquidity may not be available, right? So you can't, use that as a, so you need to balance out the liquidity of the opportunities as well as the available opportunities within the market universe. If a simple answer would be that when I look at those 700 odd companies, roughly about 55% of them are in large cap and 45% are mid and small cap. And there are evenly spread between mid and small cap, right? So one, I could say that look, over a period of time, a right way to think about would be a 50% large cap and maybe 50% mid and small cap over a period of time. And of course, there would be a variation around the same depending on market cycle and liquidity. Look, I have generally, even as an analyst and in the new role as a fund manager, I think I probably want to struggle with these labels. The reason is, I think we should not have a very fixed mindset about anything in the markets, because market gives opportunities in various forms, in various levels, right? So I don't want to say that, look, I want to look only the leaders. Yes, leaders, are typically the one who do gain shares and deliver returns, and therefore you should be taking part of them. But at the same time, you have seen examples where, some of the players who could be completely in the, let's say, tail part of the industry, but something would have changed. Either there a turnaround story or there is a management change, and many factors sort of changes out there. And at times they become very large source of portfolio returns and the alpha. So all I'm trying to say is, yes, we, in our stock selection criteria, what we are looking is essentially the earnings growth, the quality of the management, and the availability of that growth at a reasonable price. It can comes in various form. It can come in form of market leaders in a turnaround story, or even in the market laggards for that matter. Okay, look, when we look at the market in general, typically what you would observe is that there could be, let's say, three phase of returns, one would think, right? When the markets are cheap, your prospective returns tend to be much better. When markets are at a fair value, your prospective returns would be in line with the earnings growth and the fair value. And if the markets tends to be, let's say, expensive, and if there is disappointment in the delivery of earnings, then the returns could probably disappoint, or let's say you could have sideways market, right? So when I look at these three parts of the equation, and then when I look at the markets today, there's, let's call it, there's a fair bit of disregard for risk. I don't think so. We are in the zone of the bubble, but at the same time, there is definitely, let's say, little less tolerance for any negative surprise if it were to come, right? And hence, the the focus on the earnings and the focus on the business become a much more important driver, because if there's going to be, if any external risk plays out, if any negative surprises come, there could be a negative sentiment, could have a bearing on the market, right? But as a let's say portfolio manager, as an analyst, the control what you can have, or let's say the risk management that you can build, bring on the table, is going to be the focus on the earnings and pick up businesses which are more likely to have resilient earnings. So even if, let's say, they were to suffer in the short term because of the volatility of the market, probably as the earnings starts to come through, they probably would be the first one to recover, maybe the fastest one to recover. I think in the current scenario, one would be more prudent to have a much broader diversified portfolio. Having said that, this could change over a period of time. In fact, my favorite example has always been in highlighting that, even this question, you should not have a fixed mindset. I would highlight example of Peter Lynch, who has been one of the greatest fund managers in the history of mutual fund. He started his, flagship fund at, I think, $20 million of AUM. And when he retired in about 13 years or so, I think the AUM was close to $20 billion. He started with about 55, 60 stocks, right? In fact, everybody would have advised him to bring the number of stocks down. But at peak, he was owning, if I remember my number correct, at peak, he was owning close to about 1,400 odd stocks. So that tells you that, and he has been his returns has been so stellar that no fund manager has been able to beat that return, at least in the mutual fund industry, that his track record is still being sort of untouched. So that brings home the point that market is in a way we probably should not have a fixed mindset and think of a collection of opportunities depending on the fund size. Various factors would evolve over a period of time. I think it's more relevant to stay open-minded and flexible about the investment opportunities. As the cliche goes, there are many ways to skin the cat.